Welcome to the Money and Wealth Show. Brought to you this week by AmericanManganeseInc.com. This week's host is Victor Adair.
Well, we're here today with my good longtime friend, Bob Hoye. Bob, welcome. Glad to have you on the show. Bob, we've had a lot of volatility in the market lately, to say the least. It looks like countries here and there are going bankrupt. All kinds of things are happening. I know with the work that you do for institutional advisors and for your institutional customers and clients all over the world, that you've been all over this from day one, really. By all over this, I mean the credit crisis that happened. I think you really came into your own, you know, in 06, 07, when you were forecasting what you call the biggest train wreck in credit market history coming. You follow the credit markets, the equity markets, the commodity markets, that sort of thing. So if you don't mind, we're going to pick your brain a little bit today about how we got into the mess that we're in, and then get your calls as to what you think is going to happen in the world, and how we can, you know, move ourselves around financially in the world, maybe make some money.
Right, indeed.
Sounds like a fair job.
We always want to make money, either on the upside or on the downside. But what we're facing is a post-bubble contraction, because the blowout that concluded in 2007 involved the financial markets with stocks and bonds. It also involved the commodity markets and other hard assets such as residential real estate in the U.S. And when you get all of those going to the degree that they went, that falls into the classification of a classic financial mania, bubble, whatever you want to call it, Victor. And the first example was 1720 with the South Sea bubble. And then 1929, which people know of, that was number 5. And the one that concluded in 2007 was number 6 in the series since they first started. It should be mentioned that there's been a senior central bank on deck and on watch all through this. And the real story is that when the public gets the urge to become instantly wealthy, there's nothing anybody can do to stop them. And then that bids up the market to unrealistic levels, employing credit, like buying all this stuff with other people's money, your margin account at the brokers or at the bank. And then that leverages things. And it's not just the big brokerage firms with their equity trading desks or their bond trading desks that are leveraged. It's a good portion of the public as well. And a happy leverage position in a bull market needs prices going up all the time. And the moment they start to falter is when the margin clerk gets very interested in your account. And if you're offside, like the last guy in buying on leverage is usually the first guy out. So then where the mainstream in the financial markets think that the senior central bank, in this case the Federal Reserve, really is managing things. And we saw that late 2007, Greg Mankiw, Harvard economics professor, said that the Federal Reserve had a dream team of PhD economists.
A dream team like the greatest basketball players ever assembled.
That was it.
These guys, no problem with these guys at the helm.
Nothing could go wrong.
Right, nothing could go wrong.
Markets don't get overbought, they can be managed. So anyways, that was right at the actual high for the stock market was late October 07. And then things started to go down gently. But the real problem was, of course, the crash in 08.
But Bobby, come to this, though. I mean, absolutely, you nailed it. You talked about the biggest train wreck in history was coming. But that seemed like it had been coming for some time. What actually alerted you that, you know, they were going to ring the bell and we're going to make the talk?
Oh, yeah. That one is that typically the yield curve goes inverted. That means short rates go higher than long rates. The reason short rates go higher than long rates is because of the demand for speculative money, for all of this leverage that's going on. So typically the boom can run 12 to 16 months against an inverted yield curve. So the signal then in previous such bubbles where that curve is available is that so we were counting it from the early in 2007, kept saying that June would be the 16th month in a 12 to 16 month range where the reversal would come in.
That would be June of '08.
June 07.
June '07, okay.
So then in May, the curve started to change, which was the big warning. And then a few weeks later, then the credit spreads started to widen. That's the difference between treasuries and corporate bonds, which had narrowed. In the boom, everybody's confident. So it narrowed and it started to widen. So there was the telltale. So by the time I got to London in early June, the Halkin Investment Conference over there, and we had slides showing train wrecks and serious train wrecks and comical train wrecks, and that's where the line came out that will be the greatest train wreck in the history of credit markets.
So the greatest train wreck in the history of the credit markets hit us in 2007 after a generation of more and more debt, more and more leverage being built up, and then we hit the fan and things went south. We're going to take a break here and come back with more of the Money and Wealth Show in just a moment. And when we come back, we're going to really focus in on with Bob here as to what he thinks is going to be happening now that we're in this post-bubble correction or crash, right? and how you can participate financially. We're talking with Bob Hoye, and we'll be right back with more after we take this quick commercial break.
Always consult your investment professional before making any investment decision. You're watching The Money and Wealth Show.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
The Money and Wealth Show is archived online at TalkDigitalNetwork.com. Here's Victor Adair.
Welcome back. Before we took the break, when we were talking with Bob Hoye here, Bob had told us that the inverted yield curve had given him a signal that the credit crisis was going to hit a peak, and then we get a break from there. Bob, maybe just before we get to what you think is going to happen now, where we're at, let's talk a little bit about what you do with institutional advisors. Now, I know you started this back in the early 1980s. You write a letter. I read it every week. It gets distributed to institutional accounts around the world. Particularly, you understand Japan. You've got a lot of subscribers over there.
Oh, yeah. Well. We've got a good connection in Japan. The guys over there in Tokyo translate each week's work, and we have a large clientele in Japan with the work translated. And there's a number of serious investors, and every once in a while we go over and do some presentations, one in Osaka and one in Tokyo, and I really enjoy it. It's lots of fun. But the way we work is unique because, first of all, there's a database of history and the knowledge of all of the great financial events in history. And I should mention that every great big mania is always followed by a contraction. So then this gives you the outline, as I said, for the 2007 change. And then you have some technical work. My colleague Ross Clark, with his ChartWorks, is one of the top guys in charting, and it works very well. So, for example, in that back to 2007, when we were looking for the change to occur within a couple of month window, then of course you're watching for the change, and you're watching for some of the excesses in whatever was going on then, copper and then crude and that sort of thing, and then you work it out. So then, when you, for example, the first break in 07 in the stock after the 07 high, so going into 08, that was a serious decline. So then we said this is the start of a bear market in equities. And then you had some exceptional highs then in July '08 with crude oil, for example. Then on the chart works on that side, it gave what we call an upside exhaustion on a weekly basis. And we said, oh, that's enough for a cyclical bear market in crude. And that's when it was approaching 147. And then mentioned that if the signal held for a month, another few weeks, came in with the monthly reading, then that would probably be a secular bear market for coppers or for crude oil. So that was up at 147, and then it sold off hugely. So it works whether you're anything that trades and has a good history and good volume. You can get the chart out of it and it works. So what we're looking for now is for this year, we had another model came in. And we called this the Momentum Peak Forecaster. This was something we noticed in 1998 and put it together and then backtracked it through price history. And it really works well when there's big action in commodities. That one worked for us well in '98 in anticipating the crisis that took out long-term capital management, that huge hedge fund. But and then nothing was generated. '06, it gave a good signal. It turned out to be the U.S. housing market. And this year in January, this signal, the forecaster came in, gave the signal. What it says is two things. Speculation was going to continue and go to a really high level of speculation. The other one was it would likely conclude by around April, like 3 months hence. So indeed, there was the stock market high was late April, and the CRB commodity index was late April. So we had, and it was very exciting on the way up. So this then gave us the target for when it was likely to peak. So then within that, you have like around April. When you're talking in January, about April, that's a long ways away in these kind of markets. So then you get into April, and yeah, some of these price series had really sort of gone to the moon. Then within that, we have another indicator, which is the action. It was a good, outstanding market for silver and gold. So then in a bull market for those two metals, silver will outperform gold. And then you watch, for the moment silver starts to slow down, that'll be within a couple of weeks at the top for both metals. So then we have the silver-gold ratio, and you have a momentum calculator on that called the RSI. And when it gets above 85, you're close to a very serious high. This time it got to 92 on the silver-gold ratio, which means silver was really outperforming gold. And then we got the correction in both those metals. And then separately with Ross and the chart works, he's been plotting the chart action on gold in US dollar terms very well, so that the June low called for an important high for gold in late August, which we got. Then the other thing about that one was that silver has been underperforming gold since April. And that then is kind of a warning signal that, hey, a party's really on when silver outperforms gold, and it's not on when silver underperforms. So,
Bobby, let me just hold you there for a second. I mean, let's recap this. We had a tremendous credit boom through the 80s, and it ended in '07. And then we've had the fallout since then. The authorities have come in and tried to stimulate the economy. We had a rally from the March '09 lows into, say, April or so of 2010, 11. What year are we in?
This year.
This year, right. So let's take a break, and we'll come back with more of Bob Hoye and get a look at, given all of this that's happened, what he thinks is going to happen next in the markets and how you can position yourself to take advantage. We're talking with Bob Hoye, and we'll be right back with more after we take this quick commercial break.
You're watching The Money and Wealth Show.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol MOR. Website molycorp.com. Or phone me, Larry Ray, at 604-531-9639.
The Money and Wealth Show is archived online at talkdigitalnetwork.com. Here's Victor Adair.
Welcome back. We're talking with Bob Hoye, Institutional Advisors. Bob, earlier here in this segment, we've been talking about the credit bubble that we had that happened over a generation, the greatest train wreck in history of the credit markets that began in 07. The commodity market made a spectacular run for the roses and then ended in July of 08. Beginning in March of 09, the stock markets around the world had a significant rally. Let's go with the American market. It pretty much doubled from March of 09 into the April 2011 period that you'd forecast would be about a high. Since then, we've come down. Certainly the troubles in Europe have exacerbated the problems, but there's been a number of things. We've come down, but just lately here, as we're in the toward the end of September, the market feels like maybe it wants to bounce a little bit. What do you think's ahead short term here for the stock market, and maybe as we go in later into the fall?
Sure thing, Victor. That August hit to most financial markets was severe because they suddenly discovered that, Greece may leave the European community. Serious stuff. So then you're going to get a relief rally out of that. Also, you can have the first half of September can be positive in the financial markets, even though there's a credit disaster going on in the background. So now, this week, it looks like this favorable stock market, favorable gold, could run for a few weeks more. But this would probably is that the hit to the markets in August was severe enough that some relief is going to prevail. But you still have the ongoing problem is that as the economy slows, and it will continue to slow, the street and many people are going to figure out that the stimulus, the big stimulus out of the U.S., did not work. And of course it won't work because it has to go into the banks. Banks mean Wall Street, and Wall Street are not going to bid up losers like residential real estate in the U.S. Instead, they went into the next set of winners, which turned out to be the stock market and commodity prices. And you had then, out of the crash that ended in 09, you've had the first business cycle in a post-bubble contraction. And it probably peaked around May with the commodities. Often in history, the high for commodities is fairly close to the high for the business cycle. So what we're looking here for now is continuous economic contraction. In the U.S., unemployment numbers that are really unpleasant. But you have some life in the stock market for the moment. But for those with a longer point of view, you want to consider that there's no long-term holds in stock markets, in corporate bond markets, or municipal bond markets, or even Government of Canada or U.S. Treasury markets. You have to have more of an intermediate point of view and watch out for risk.
So short term here, you think the stock market can do a little better, but as we go into later this year and certainly in the spring of next year, you think it's headed lower?
Yeah, because of a recession going on.
Right. How about gold stocks? I mean, gold stocks have been, relative to gold anyway, they've been doggy. What do you?
They've been cheap.
Yeah, cheap. Okay.
Cheap.
Is that going to change?
At some point. But what you have here is that the rally in gold was brilliant, but it was a flight to liquidity. There's two items in the world that are the most liquid. U.S. Treasury bills. That's why Treasury bill yields are so low, like next to nothing. And the price of gold took that big rally right into August. But the stocks weren't keeping up with it because the gold stocks are held under influence by what's going on in the New York Stock Exchange, so the general market. But you have some things going on this year that are very constructive for gold. The real price of gold, that's the price that it's worth in purchasing power, like gold has been improving relative to crude oil. That reflects energy prices. So that's been on since April, and so that means their profit margins are improving. But the problem will be the stock markets over the next little while. So on the next intermediate low for the general stock markets would probably be a very important low for gold shares, and then the next leg up for gold shares will be spectacular, and because it'll be driven by improving profit margins, whereas the general stock market will be driven by decreasing profit margins and perhaps earnings disappearing altogether. So in a few years' time, we would expect gold shares to be very much higher than they are now, and that the general stock market, i.e. the New York Stock Exchange, would be very much lower with some big swings in between. And as I say, you have to look at the intermediate market rather than the long term, because there is no real long-term investments you can hold. So,
Bob, we just have a moment left, as you can imagine. You got a comment on the real estate market in Western Canada here? It's been so strong.
Oh yeah, it's strong because of a lot of money coming in from Asia. It's been a long bull market. But if we look at the big high for gold and silver in 1980, I remember then the Vancouver property market was very high. British properties was a good example, and the high was probably early 81, and then it fell, I remember, to 1/3 of the high. Then there was another example in Toronto.
So you think we're at risk of not holding these prices?
It's possible.
We're talking with Bob Hoye, and we'll be right back with more after we take this quick commercial break.
You're watching The Money and Wealth Show.
American Manganese Inc. has a manganese deposit in Arizona, indicated 6.7 billion pounds, inferred 8.9 billion pounds, potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
The Money and Wealth Show is archived online at TalkDigitalNetwork.com. Here's Victor Adair.
Well, welcome back. We've been talking with Bob Hoye, my good longtime friend. Bob is in this segment here. He's talked to us about how he foresaw the biggest train wreck in the credit market history happen and the implications that was going to have for the other markets. We certainly had a crash, Bob. We've come back from that. And you're saying kind of at this point here, maybe we can do a little better short term in the stock market, but then we're probably headed lower as we go out into the fall and into next year. Gold market's going to do better. Gold shares should do a lot better. And you're really skeptical about the Vancouver real estate market. Bob writes for Institutional Advisors. You can get a free trial, institutionaladvisors.com. Bobby, it's been a pleasure to have you with us here today, and we have to say thanks to Fritz at Churchill's Licensed Lounge here in North Vancouver for the hospitality.
The Money and Wealth Show has been brought to you by AmericanManganeseInc.com.